Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about technical analysis with options trading. Now, this is a topic that's fairly near and dear to my heart because as a market strategist, I spent the first 7 years of my career at a firm called Forex.com. If any of you have traded currencies, you're probably familiar with that firm. And when we trade currencies, we predominantly use technical analysis for our research. Technical analysis is heavily used in currency trading, and that's really where I had the opportunity to work with thousands of clients, both on the retail and institutional customers, to basically understand different strategies that they used and help them better understand the currency markets. And that's really where I learned about all different types of trading strategies, different indicators, different ways to look at charts. And I looked at charts anywhere from tick charts all the way down to monthly charts and everything possibly in between. And I've seen just about, I would say, most technical strategies under the sun. And so I have a strong gravitation towards using technical analysis with my trading. But I think the one thing that I've learned as a strategist working with different traders with technical analysis is that I always come back to keeping things as simple as possible. So today what I want to do is I want to help everyone understand the different forms of technical analysis. And today what we're going to do is just scratch the surface of technical analysis, but talk about the broad ways that you can use technical analysis. And more importantly, talk about what option strategies are suitable for different forms of technical analysis. And we're going to go over a few different types of options trades that you might be able to make and show you why they are only suitable for certain forms of technical analysis. And this will hopefully help illustrate as to when you should use certain option strategies and when you should not. So with that, let's go ahead and get started. Before I do, just a quick reminder for those of you that are brand new to OptionsPlay. If you've never used our tool before, you can sign up for a free 30-day trial using the link that's currently on your screen, which I will post into the chat window for those of you that want to sign up for a free trial and listen along. And if you want, as part of that, you will get a free 12-step options trading course and daily options trading ideas during your free 30-day trial. And membership after that is only $75 a month or $500 a year. So here are the things that I want to cover today, and I have a lot to cover. First, I want to talk about what is the value of technical analysis. I want to explain to everyone why I use technical analysis with my trading and why it's suitable for specifically options trading. Then what I'll do is I'll talk about which option strategies are suitable for technical analysis. I'm going to cover 3 different option strategies. They are the most popular strategies that you would use if you have a bullish or bearish view on an underlying stock. Perhaps some neutral views as well. So bullish, bearish, and neutral views, because those are predominantly the 3 different outcomes that you would typically find when you use technical analysis. And then once we define the option strategies, we'll be able to go through different forms of technical analysis. Like I said, today what I'll do is I'll cover broad categories, and this is by no means an exhaustive list of technical strategies, but it does cover the broad categories. So we'll look at price analysis and patterns, we'll look at chart overlays like moving averages and Bollinger bands, and then lastly we'll look at momentum indicators like RSI or stochastics or MACD that many of you guys like to use. And I want to make sure that everyone understands what are the suitable option strategies for each technical strategy, so that you are applying your option strategies in the most efficient way, because it's all about deploying your capital efficiently based on the outlook that you have on any stock or ETF. And then lastly, what we'll do is we'll look at OptionsPlay, we'll bring up some samples, some trade ideas, and show you why certain strategies are suitable for different forms of analysis. So let's go ahead and get started. First, let's talk about what is the value of technical analysis. So before I get started, just to define what technical analysis is, it's simply forecasting future price based on past history. So it's looking at what has happened in the past to anticipate what is likely going to happen in the future. And what you get out of technical analysis is three very important things that you generally need to have when you trade options. And those three things are a sense for direction, which I think is fairly obvious as to why we want to get a sense for direction. Second one is magnitude. And that is this, in magnitude, what that means is if I have a directional view on a stock, I think it's going to go higher or I think it's going to go lower. How much do I think it's going to go higher or lower by? Do I think it's going to go up by 2%, 5%, 10%? Very important to understand that. And lastly, how long do I think that will take? So if I think a stock is going to move 5% higher, do I think that's going to take a day, a week, a month, a year? Very important, because when you're trading options, you have an expiration date. So you need to have a sense for direction, magnitude, and timing in order to trade options. And what I like about technical analysis is that when applied correctly, you can effectively look at thousands of instruments across every asset class using the same type of analysis. So whatever I use to look at Apple stock, I can take that same analysis and apply it to interest rates. I can use it for the indices. I can use it for commodities. And I can use the same analysis across the board. And that's something that can't be said for other forms of analysis. So what it provides for me very much is an objective view on the price. And many times, I'll hear from users that will say technical analysis is very subjective. And what I usually respond to that is the subjectivity comes from different ways of analyzing an indicator. So what's really important is that you use the same indicator in a consistent manner so that you get an objective view. And I'll talk a little bit about that when we get to some of those indicators. But the second most important thing about technical analysis is that it's applicable to all instruments with a price, meaning I can use this to analyze any asset class. So what I learned in my technical trading in currencies, I can directly apply it to trading stocks or ETFs or any other asset class. But lastly, the most important piece I actually think is the fact that technical analysis is applicable on all time frames. So regardless of whether you are a day trader and you trade every single day, or you're a long-term investor where you might trade once a month, you can use the same analysis on a 5-minute chart as you do on a daily or weekly chart. And this really allows technical analysis to be extremely flexible, so we can all learn the same method of technical analysis and apply it to different asset classes and different time frames for trading. And you can't do that on any other form of analysis. If you're a fundamental analyst, you can really only use that for relatively longer term time horizons for equity investments. You can't apply that to trading commodities. You certainly can't use that for day trading. So there are a lot of limitations that you have with other forms of analysis that technical analysis provides much fewer limitations. Now, technical analysis is not without fault. There are limitations as well. So it's important to understand that whenever you're using a technical strategy, that they only work in certain environments. So if you're using a moving average, you need to understand that those strategies tend to work better in trending environments, and they don't work as well in sideways markets. So it's important to understand when your strategies are ideal and when your strategies are not, because that's the best way for you to go back to, after you have a trade, and look back and say, was this the right environment for the type of strategy that I was trading? And the last thing is the fact that I get this question a lot. I get asked the question, what's the best indicator, or what's the best strategy? And the answer is there is no such thing as a best strategy or best indicator. You really want to just find an indicator that works, or find an indicator that you're comfortable with and stick to it, because there's no such thing as a best indicator or best strategy. It's really about finding one that you understand, one that you're comfortable with trading, and sticking to it, because that's what generally sets successful traders apart from everyone else. So With that, what I'll do is I want to go through a few different types of option strategies. I'll break down the strategies themselves briefly for those of you that are new to these types of option strategies. But again, this is not meant as an options strategies course. If you want to learn more about these specific option strategies, we have videos on them separately that you can view at your own pace. But the reason that I want to discuss these option strategies is because whenever we look at charts, and many of you that use technical analysis is probably familiar with this concept, is that we many times spend hours and hours looking at charts and then only spend a few minutes or maybe just a few seconds to look at the trades that we're going to make. But at the end of the day, it's the trades that generate our profits, not the technical analysis. The charts don't make you any money. The charts are only there to help guide you. It's your trades that make you the money and potentially account for losses. So it's really important that we spend some time analyzing our trades and seeing do the trades that we're making line up with the technical analysis that we're doing. So what I have here on my screen is a division, and the division is across the middle. And on one side, I have strategies where based on my technical analysis, I may have a clear sense for direction, which means that I'm very clear that I'm either bullish or bearish on, but I may not have a very clear sense for magnitude. So there are certain forms of technical analysis that that will give you a clear sense for whether a stock is going to move higher or lower, but it doesn't really give you a sense for whether it's going to move 1% higher or 5% higher or 10% higher. And if that's the case, there are two different strategies that you can trade. Conversely, if you do have a clear sense for direction and you have a clear sense for magnitude, then there's one strategy that you can trade on that specific front. So on the clear direction but unclear magnitude side, it really depends on whether you expect the move to happen to be quick and fast, or if you expect it to be relatively small or neutral. Because if you expect a move to be quick and fast, and we'll explain as to what type of scenarios that will be, you want to make sure that you typically will want to buy a call or a put. That's a fairly simple option strategy that allows you to take advantage of a quick and fast move. These have good risk to reward ratios. They typically have lower probabilities of profit, but especially when you expect a quick and fast move, that's what you're really looking for, is that really good risk to reward ratio. And conversely, if you expect the move to be relatively slow or maybe neutral, you want to sell credit spreads. Now, credit spreads typically have much higher probability of profit, but the trade-off for that is they then typically have poor risk to reward. So those are the different strategies that you would use if you have a clear sense for direction, but an unclear sense for magnitude. On the flip side, if you have a clear sense for of a direction, and you also have a clear target price as to where you think that stock will go, then you generally want to buy debit spreads. So debit spreads have relatively good risk to reward ratio. They typically do have lower probability of profit, but they are very good for lowering your risk on a trade or providing very good risk to reward ratio, especially for a very defined move. So let's just explore these strategies very quickly as to what are the best practices for each one. And I'm going to talk about buying spreads first, or buying options first, and then we'll discuss selling strategies next. So first, we're going to talk about buying calls and puts. So this is where we're trying to profit from a large, fast move in a specific direction. So if you think that the stock is going to move substantially higher or substantially lower in a relatively quick fashion, buying calls and puts is a great strategy to use. And the rule of thumb here is you generally want to select expirations that are at least 1 month or greater, because whenever you're buying options, you want to negate time decay as much as possible. And one of the best ways to do that is to simply buy a longer dated option. They will decay at a slower pace. Now, whenever you're buying a call or put, you need to buy a slightly in the money call or put as a starting point. About a 50 to 60 delta call or put is a good starting point. Now, when you're thinking about a move in a more directional view where you have a target price, this is really where you want to consider using a debit spread. So for those of you that are unfamiliar, what that means is just simply a long call or put vertical. This will allow you to profit from more of a modest directional move where you have a clear target price. And a rule of thumb here is the same. You want to buy an expiration that's at least 1 month out, and you're effectively doing the same thing. You're buying a slightly in the money call or a put, about a 50-60 delta call or a put. But because it's a defined move and you have a specific target price, you generally want to sell a slightly you want to sell an out of the money call or a put against that, which will help offset the cost of buying that long call or put. It will improve your break-even price on the strategy, and it will even further decrease the time decay that you have on the overall strategy. Now, both of these strategies, because you're buying options, you want to close out the strategy before expiration, either at a profit or a loss, but you want to make sure you close this out before expiration. Now, again, this is just a very quick overview of these two strategies. If you want to learn more, please watch some of our webinars just on these two strategies alone. We actually cover calls and puts and debit spreads on specific webinars so that we really go in depth into each one of these strategies. The third strategy we're going to cover here today is selling credit spreads. This is for when you expect a small or neutral move in an underlying stock. So otherwise also known as a short call or put vertical. Now, with credit spreads, because you're selling options, this is really, you want to sell relatively short dated options. So 3 to 4 weeks out is usually a good starting point. You always want to sell an at the money call or a put to start with. So about a 50 delta call or a put to sell. That's the neutral piece of this strategy. Now, the problem with selling just an at the money call or a put is that it has large amounts of risk. And many times, most users may not even have the ability to sell a naked call or a put. So one of the ways to avoid that is to simply buy an out of the money call or put against that, which limits your risk and allows you to trade, this trade without being naked a call or a put. Now, because you're selling an option here, this is where you do want to hold the strategy until expiration and try to allow it to expire worthless at the end of the contract's life. So very different from buying options, but these are the best practices for when you're selling options. So those are the three strategies we're going to cover here today. And what we want to do is we want to go over different forms of technical analysis and talk about when you should use specific types of options trades. So the first one I'm going to cover is basic support or resistance lines. Now, support or resistance lines can be viewed in many different ways. I'm going to start off by talking about horizontal support or resistance lines because they tend to be easier to understand, but there are many variations of support or resistance lines. So starting off with just horizontal support or resistance lines, you can really think of them as floors and ceilings. I usually think that's a better way to understand support or resistance lines. You can basically find them by looking at where the price of a stock has reacted to a specific price over and over again. So when you have a floor, that's when the stock reaches a certain price and bounces higher. Let's change the color here to make it a little bit more obvious. If it hits the floor, which here is about $40 or so, and bounces higher, as you can see, it does this multiple times. That's what allows us to say $40 is a floor. And when it does the same thing on the opposite end, when it hits a higher price and gets rejected, like we have here when it reaches this $48 level or so, this is where we have a resistance line or what we call a ceiling. So whenever the stock hits that floor, we basically expect the stock to move to the floor, and then vice versa. When it hits the floor, we believe that it's going to move back up to a ceiling. So this is a trading range. Now, support or resistance lines do not necessarily have to be horizontal. They could be on an angle or what we call trend lines. You can also have support or resistance lines drawn using channels, or there's many different variations of it, but the whole point is to really define a support, a floor or a ceiling that you believe the stock will bounce higher or lower from. So there are a few different ways that you can use support or resistance lines. So the most common one is that when it hits a floor, you believe that it's going to move back up to the ceiling again. And when it hits the ceiling, you believe it's going to move back down to the floor. Now, because that is a trade that has a very clear directional view, because when it hits the floor, you're bullish, when it hits the ceiling, you're bearish, and you can use previous support or resistance as your target price. One of the most efficient ways to deploy your capital when you're trading using support or resistance lines is to use a debit spread. A debit spread, it basically allows you to trade a defined move. In this particular case, you might buy a $40 call down here, around $40 or so, and then sell maybe a $47 or $48 call above. And this gives you a very, very defined way to play the stock between $40 and $40 and $48 without taking on a large amount of risk or risking a very small amount of capital than buying 100 shares of the stock at $40 a share. However, there is another way that you can use support or resistance. Now, this might be based more on your perhaps more fundamental or other biases that you might have for stock, is that maybe when it reaches resistance, you may not believe that this stock is going to go all the way down to 40, but you just simply think that the stock is just going to move a little bit lower here, maybe from 48 down to 46, and you think the stock is just going to maybe trade in a bit of a sideways range like you had here, where it didn't move much lower before here. It just kind of moves sideways here for almost a month or so. If that's the case and you're not overly bearish when it hits that resistance level, what you can do is you can sell a credit spread. A credit spread allows you to take advantage of the stock basically not moving any higher. So as long as the stock doesn't move higher like this, you're going to be able to make money even if the stock stays just sideways here within this tight range. And a credit spread allows you to do that as long as the stock does not exceed that resistance level. So those are the two different ways that you can look at a support or resistance level. And again, support or resistance levels do not have to be straight horizontal lines like the one that I have here. They could be in other forms of support or resistance. Now, so far I've thrown a lot at you, so I just want to pause for 1 second here and just do a quick check. Does what I'm speaking of here with support or resistance and looking at it based on where you think the stock is going to go and choosing debit spreads versus credit spreads, does that make sense to everyone? If it does, please type yes into the chat window. If it does not, please type no, and we'll try to answer as many questions for everyone at the end. But I just want to do a quick check with everyone to see if everyone feels that they understand what I'm saying about selecting the appropriate strategy based on your outlook using something like support or resistance lines. Okay, great. Look, I see a lot of yeses, which is great. I just want to make sure everyone understands where I'm heading with this. Great. So now that we've looked at support or resistance lines, now let's take a look at using the support and resistance lines in a different way. So before I was talking about support and resistance lines where it trades within a range. But a stock can actually, you can identify or support a resistance line, and after a period of time starts to break out above that support or break down below that support. And what this typically sets you up for is a very large move. And this move can happen in a few different ways. It can just simply break out of a resistance level and just take off. It can take off, come back down, test that support level before moving higher. But most of the time, what this results in is a relatively large move to the upside or to the downside if it breaks a support level, which is why, generally speaking, when you see these types of breakouts, one of the most common ways to trade this is to simply buy a call option. And I'm talking about breakouts here, meaning a break above resistance to the upside. Because usually when you get these types of breakouts, especially when the stock has tested a resistance level for quite some time, as you can see here, It tested it once here, back multiple times, 1, 2, 3 times it got rejected at this level, and it finally broke above it. Those are usually setups for a big move to the upside. And because of the fact that there's no prior history and we don't have a clear sense for whether this stock is going to move $1 or $5 or $10, but generally we think this is going to make a big move to the upside relatively quickly. And the key part here is the fact that we think it's going to move relatively quickly. Buying calls is usually a better way to trade this. Now, if on the other token, the stock breaks out above a resistance level, but you're not overly bullish, but you simply feel that the stock is just not, you're not overly bullish on the stock, but you're pretty sure that it's not going to go back below a level, and you think that maybe it'll just bum around this level and maybe move a little higher, but you're not overly bullish, then you can sell a credit spread. And a credit spread allows you to basically profit as long as the stock does not drop below that support level. So once it breaks above that resistance level, it becomes support. And as long as it doesn't plummet back below into that $80 level again, you can make money by simply selling a credit spread. So those are the two different ways that you can play breakouts. However, on a breakdown, when the stock breaks below a support level, this typically is a little different, because when a stock breaks down, you usually have price history that shows you how much further it can go. So when you have that price history, first of all, the long puts make sense for a breakdown simply because breakdowns typically move a little faster. So we usually say stocks will take the stairs on the way up and then take the elevator on the way down, meaning usually big moves to the downside happen typically more violently and faster to the downside than they do to the upside. So whenever a stock breaks below a support level, buying puts is a simple way to play that move to the downside. But if you think that the stock's going to move to the downside and you have previous price history, so if, let's say, for example, this stock gets rejected here and you have a prior low that you can reference here, let's say the $72 level, and you have a clear sense for how far it can go, many times you might get a better risk-reward ratio by trading a debit spread, where you buy maybe an $86 put and then sell a $72 put to the downside to collect a little bit of premium, and that helps reduce your risk of the overall trade. And as long as you sell a strike based on a support level, then you typically are going to be okay and not limit your gains too much to the upside if the stock does go in your favor. So again, I just want to do a quick check. If that makes sense to everyone, please type yes into the chat window, just so I can get a sense for making sure that everyone understands this. Great. Lots of yeses, which is great. Next, let's take a look at chart patterns and reversals. So a lot of people like to use different types of chart patterns. Now, the thing about chart patterns is that they tend to be a little bit more subjective. Head and shoulders, double tops, double bottoms, and things like flags and pennants, cup and handles, those tend to be even a little bit more subjective. I think double tops are probably the least subjective, double tops and bottoms. So the thing about double tops and bottoms is that they give you a clear sense for direction, but keep in mind that a double top or bottom does not give you any sense for magnitude. Just because the stock hits a level twice does not mean that it's going to reverse $1 or $5 or $10. There's nothing in the fact that a double top is formed that gives you a sense for how far it's going to reverse. So generally speaking, when you identify a double top or a double bottom, we tend to find that selling credit spreads at that double top or double bottom tends to be a better way to play it, because this way, it doesn't matter whether the stock reverses $1 or a couple of dollars, you're able to make money from a credit spread, versus if you buy a call or a put, the stock needs to make a big move before you can make money on that strategy. Conversely, on a head and shoulders reversal, which is similar to a double top or double bottom, but a head and shoulders does give you a clear sense for direction, and it gives you a clear sense for magnitude. So if you ever use a head and shoulders pattern, you can use the neckline to measure how far you think the move will happen. So if that's the case, you want to use either long puts or potentially debit spreads to take advantage of a measured move. Conversely, on a cup and handle reversal, again, this is a bit of more of a subjective pattern. I think everyone draws their cup and handle a little differently, but cup and handles also provide clear sense for direction and a clear sense for magnitude. So for that, long calls and usually debit spreads are also very suitable for a cup and handle. And the only difference between a head and shoulders is that typically they're bearish. Cup and handle is typically bullish. That's why one you would trade puts on, the other one you would trade calls on. And lastly, flags and pennants. These are continuation patterns. These are usually when a stock makes a big run, consolidates for a while, and then you believe it's going to continue running in that same direction. Flags and pennants give you a clear sense for direction, and because they are measured moves, you can also get a clear sense for magnitude. So for those types of strategies, buying debit spreads usually are a good strategy for trading flags and pennants. So chart patterns are a little bit more subjective, but if those are the types of trades that you like to make, or if you use different types of scanners that scan for these types of patterns, make sure that you're utilizing a strategy that is suitable for the chart pattern that you've identified. So next, let's move on to lagging indicators or chart overlays. And this is very, very popular for many traders, is using indicators like moving averages. If you use moving averages, type 1 into the chat window, just so I know how many of you have used moving averages in your analysis, because I know I use moving averages in my analysis. It's a big part of the different types of trend analysis that I do. We use it in our 1 month and 6 month trend analysis on OptionsPlay. So it's a big part of the work that we do here. Now, the one thing about moving averages that I think many people misuse sometimes is the fact that moving averages give you a clear sense for direction, but what they do not give you any sense for is magnitude. And what I mean by that is when a stock breaks below its moving average, usually that's considered a bearish condition. So whenever the stock moves below its moving average, that's considered bearish. And when a stock moves above its moving average, it's considered bullish. However, when a stock moves below its moving average, there's nothing in that crossover itself that tells you whether the stock is going to move a couple of points in your favor, 5 points in your favor, 10 points in your favor, 100 points in your favor. There's nothing in that moving average crossover that gives you a clear sense for direction. A clear sense for magnitude. So there are two ways that you can play this. If you are overly bullish or overly bearish on the stock, then typically what you might want to do is simply buy a long call or a put, because again, this stock can make a big move to the downside as a result of a crossover. And especially if you have a bullish or bearish bias, I think the best way to take advantage of that is just simply buying a call or a put. As you can see in these two examples here that I've just highlighted, buying that put when you get that crossover, it gives you a very nice move to the downside. They tend to move pretty quickly. And then when it crosses back above, buying a call option really allows you to take advantage of that big, big move to the upside. However, if you're not overly bullish or overly bearish, you should really think of moving average crossovers as really just a support or resistance level that it's violated. So when it breaks below that moving average, you've basically created a new resistance level that it's unlikely going to break above. So what that means is that you can sell credit spreads at that level. Same thing here. When it breaks below that resistance level, you can sell that credit spread. So as long as it doesn't move back above it, you're going to be okay. Same thing here. When it crosses back above its moving average, that's a new support level. And basically, you're saying that the stock won't go below that support level again. As you can see, that's what you get here. Same thing here. You get that moving average acting as support or resistance. So once it breaks below, it won't go above it. And when it goes above, it won't go below it again. So those are the different ways that you can use moving averages, but you can really utilize this for moving averages of any time frame. But I will say that you should typically choose moving averages based on how frequently you trade. So if you're a long-term trader, you want to use a longer-term moving average. If you're a short-term trader, you might want to use a shorter-term moving average. There isn't a right or wrong answer as far as which moving average you use, but I will say if you're going to use a 50-day moving average today, you should use a 50-day moving average every single day. You should not use a 20-day today, a 50-day the next day, a 200-day the day after. I see a lot of that from users is, they might use the 50-day moving average today, but next day, if the trade, if they use the 50-day and it doesn't jive with their bias, they tend to move on to a different moving average, because then what you're doing is you're just searching for a moving average to agree with your own biases. So you're not using it in a very subjective way. You're not using it in a very objective way. You're using it in a much more subjective way. And if you do that, you're going to get inconsistent results. So remember, when you get a moving average crossover, the crossover itself does not give you a sense for magnitude. So remember that. Make sure you use a strategy that is suitable for the fact that you don't have a clear sense for magnitude. Second of all, I want to cover Bollinger Bands. Very popular strategy, again, for technical traders. Now, the thing about Bollinger Bands is that they do give you a clear sense for direction, and they give you a clear sense for magnitude, because Bollinger Bands give you very specific target prices. And typically how Bollinger Bands are used, and there are, I will say, different ways to use Bollinger Bands, but one of the more common ways is that you use them as a retracement strategy. So when the stock exceeds its upper band, you believe it's going to retrace back to its moving average. If it retraces, if it exceeds that upper band, it retraces back to the moving average, and same thing when it exceeds the downside. These are bullish trades here to the downside and bearish trades to the upside. Now, generally speaking, I generally don't like to trade against the trend. So not a favorite strategy for me, because usually these are counter trend trades. You can do them, but be very careful. And this is why I typically advocate that if you're going to use these types of retracement trades where the probability is not really in your favor, is to use debit spreads, because debit spreads really allow you to take advantage of these quick moves with the smallest amount of risk possible. Because again, these are counter trend trades. They typically last relatively short trades. As you can see, most of these trades just last a few days. In nature, these retracement trades, when they do happen, they happen very, very quickly. And you want to make sure that you are in and out of these trades very, very quickly. Most of them just last a few days, maybe a few weeks at most. And the best way to protect yourself on these retracement trades is to use debit spreads, because they, again, risk relatively small amounts of capital to trade. And lastly, what I want to do is I want to go over leading indicators. Now, this is probably the most popular way of trading with technical strategies. Now, if any of you use MACD, RSI, or stochastics, please type those indicators that you use into the chat window so I can get a sense for which ones you guys like to use. Francois likes to use MACD. Eric likes to use RSI. James says all three. So what I tend to find is that a lot of people like to use these indicators, and what I've seen over the years is a lot of people will use this, multiple ones. They'll use RSI, they'll use MACD, they'll use stochastics, PMO, RSI. I've seen all of these different indicators that you say that you guys are using. But one thing I want to remind everyone is that all of these indicators are measuring the exact same thing. They're measuring momentum. They just have different calculations, but they're all measuring the same thing. So generally speaking, I advocate, if you're going to use one of these momentum indicators, select one and use only one. Because if you're going to use multiple ones, you're likely just going to create more conflicting messages than you really want. Because again, they're all measuring the same thing. They're measuring momentum. They just have different calculations. Notice how all momentum indicators are effectively an indicator that oscillates around some kind of zero line, whether that zero line's at 0 or at 50, but they all oscillate between two extremes around a zero line. And that's how you know why momentum indicators are all measuring the same thing, because they're all giving you a sense for whether the trend is slowing down or speeding up. So one of the things that I want to make sure everyone understands is that momentum indicators give you a clear sense for direction, because all of these momentum indicators have these what we call sell signals or buy signals that tell you when it's time that momentum is rolling over. And what these buy or sell signals is really telling you is that momentum is reversing. That's all it's telling you. But it's important to remember that when it tells you that momentum is reversing, it does not tell you whether it's going to reverse by 0%, 1%, 5%, or 10%. So it's very important to understand that momentum indicators do not give you a clear sense for magnitude. So when I get this sell signal on, in this particular case, stochastics, it doesn't tell me whether the stock is going to reverse a little bit or a lot. And when I get this buy signal down here, it doesn't tell me whether this indicator, this stock is going to move higher by a little bit or a lot. And that's an important thing to remember. So when you're trading using momentum indicators, it's almost always you should use credit spreads, because when you get a sell signal, what that usually means is that you've reached a local top, and the stock is unlikely going to exceed that local top. Same thing when you get a bottom. When the stock gets a buy signal, what that means is that the stock is unlikely to move lower beyond that level. So what you should do is you should sell these levels as credit spreads, because as you can see, whenever I get the sell signal, the stock is unlikely going to break above, and because that's really what the momentum indicator is telling you. Same thing here, it's unlikely going to break above that level, and same thing here at the bottom. When I get this buy signal, it's unlikely going to move this way. It's not telling me that it's going to move that far. It's only going to tell me that it's not going to move below. So keep that in mind when you're using these types of momentum indicators, that yes, it's telling you a reversal, but it's not telling you how far that reversal is going to go. So with that, that's why it doesn't make sense typically to use these indicators to give you a sense for buying a call or buying a debit spread. Now, I will say, when you get a strong trend, when the stock is trending in one direction and you get a buy signal, that is the only time where you might consider buying a call or a call spread, because you're basically trading with the trend. So again, if that makes sense to everyone, please type yes, because this is one of the most important things that I think any technical trader needs to understand with the limitations of technical indicators, because many of you use these indicators, and I want to make sure everyone understands that what are the best ways to use these indicators. Okay, great. I see a lot of yeses. So let's wrap this up here. I went over a lot of different things. I want to continue to make sure that we are making sure that everyone understands this. But whenever we're looking at technical analysis, I want to stress that whenever you're using technical indicators, I've seen traders use lots and lots of indicators on their charts, and by the time they finish putting on all their indicators, they don't even look at the price anymore. And what I want to stress is that price is the most important indicator for you to use. Use price to first determine your direction and magnitude bias, and then you should only use all of your indicators to provide some kind of confirmation only. You should never look at a technical indicator to say, okay, I'm going to buy the stock, without looking at the price of that stock first. You have to first look at price. Price will tell you a lot more things than any indicator will do. And the best thing to do is to use fewer indicators to avoid what we call analysis paralysis. So if any of you have put 4, 5, 6, 7 indicators on your charts, you're probably familiar with this concept where 5 of the indicators tell you one thing and 2 of them tell you another thing, and you're really not sure what to use. And the only way to prevent that is to use fewer indicators. Use one trend indicator, use one momentum indicator, and that's really all you need. And if you have a price indicator and you have price on top of that, in my opinion, that's really all you need to do technical analysis. Second tip that I really have for those of you that use technical analysis in your trading is understand your strategy fundamentally. If you read online or read on some forum some complex strategies that someone else uses, but you have no idea why those indicators that he uses or how he uses them, and you're just following it, that's really where we tend to see traders fail, because you don't really understand why someone's using certain indicators. So when you have some losses, you don't really have a way to look back on the trade and say, well, did I do this trade correctly or not? Or was this the right conditions for these strategies to work? And when you don't have that ability to look back on a trade, that's when you tend to jump ship once a trade has a string of losses. And what tends to happen from a lot of traders is the second you have a string of losses, you try to search for a new strategy, because every strategy is always going to come across a time where you have a string of losses. You need to be able to look back on those trades and say, was this the right trading environment for my strategy? If it was, then maybe it's time to reevaluate my strategy. But if it wasn't, then you should continue to trade that strategy and wait for the right environment. And lastly, the most important part is to stay consistent with the same strategy. What sets successful traders apart from others is that they don't change indicators just because it didn't work for them for the last few trades. They don't start moving they don't use different indicators because things don't work out for a few different trades. They stick to the same strategy day in and day out because they believe and they understand their strategy, and they know that they need to be patient for the right environment. So whenever you're trading options, remember, you want to make sure that you select the optimal option strategy based on whether you have a directional view and whether you have a magnitude outlook on that underlying stock or ETF. It's really important to understand the relationship between risk to reward and probability of your option strategy, because different option strategies have different probabilities. Some have very high probabilities with very poor risk to reward. Other ones have low probabilities, but very high risk to reward. So it's important to match up the probabilities to the type of technical analysis that you're doing. And lastly, you can experiment with all of these different strategies using OptionsPlay. So I know I spent a lot of time here today looking at technical analysis, and it was really important that I use the slides to help illustrate these types of trades. So with that, what I want to do is just spend a few minutes walking you through how to utilize OptionsPlay to actually do the things that I explained to you here today. So what I want to do is I want to actually pull up some trades that we recently provided as part of our daily play. I want to look at Activision Blizzard. This was one of the trades that we currently went long. And I want to take a look at some trades to see how we can utilize Activision Blizzard to maybe look at some trades. Now, Activision Blizzard, the reason that we looked at this trade was because this was a stock that really was in a very tight range for a very long time, and recently just broke out above that range, that 62.5, the support level. As you can see, it's been trading in that range since November of last year. So almost a whole year between 39 and 52 or so. And it finally broke above that resistance level. And what this last push provided was really a really good relative strength, because this was during a time when the markets were flat. That's why we have a relative strength of 9. 1 month and 6 month trends were bullish, broke out above a resistance level, and came back down to test that support level. So it broke out above that resistance level, came back down near that support level, and what our thesis was is that we believed that this stock was going to take off. So what this does is it allows me to look at the individual trade. I have some price history to look at on this particular stock, because it recently broke down below that $62 level, but when it gapped down. So I really have a clear target price on this particular trade. I believe that it can move back up to that 62 level, which is why we decided to use a vertical spread to trade this move, because we have a clear defined move to the upside. We believe that the stock is going to move higher. And the reason that we use a debit spread is the fact that it really allows us to do so in a relatively defined way, so that we are risking a very small percentage of the underlying stock. Because to buy 100 shares of the stock would cost me roughly $5,400. Buying a call spread only roughly a little over $200. So less than 5%. I'm risking less than 5% of the underlying stock to make a bet that this stock can rally back up to that $60 level or so. And if I'm right, I'm going to make a roughly 150% return on that trade. If I'm wrong, I'm risking many times just a couple of $100 to do so. And many times we are taking profits or cutting losses well before we lose that 100% of the premium that we pay. So this is just a way that you can utilize OptionsPlay to type in any symbol that you have a bullish or bearish view on. Let's say we look at Netflix. Netflix is really breaking down recently, broke down below a pretty significant support level at 280. And, we're halfway down to that next support level around that 230 level, and we still have quite a bit of ways to go. And what's interesting is that it broke down below, came back to kind of jump back a little bit, and I think that perhaps we have some more momentum to the downside because, again, very weak relative strength, meaning it's clearly underperforming the overall market, a relative strength of 2. 1 month and 6 months trends are bearish, so everything is leaning towards more of a bearish view on this underlying stock. And what we have is a very defined move to the downside. So buying a put spread in this particular case, in my opinion, is suitable, really allowing us to take advantage of a move down to that 230 level or so, and being able to make about 143% move to the down, 143% return to the downside if the stock does move lower, and risking less than that if the stock does move higher. I always wanted to risk less and make more if I am right on the particular trade. But lastly, on a stock like maybe SPY, what's interesting is that SPY has really held the 295 support level. Now, in this particular case, I'm not overly bullish on the market because there's only, the fundamentals are not very strong for the markets. Corporate earnings is not particularly strong. It's slowing down. So I'm not overly bullish, but I do see 295 as a clear support level, and it's been holding that for the last few days. So it's even strengthening my thesis that 295 is a support level that might hold on SPY. And this is really where it might make more sense to sell a credit spread, because I'm not overly bullish, but I'm pretty sure that, or I believe that the 295 level is going to hold. So I might sell that 295 credit spread and basically make money as long as the stock stays below or above that 294, 295 level. And that's really something that you can utilize as an alternative way to defend a level, as opposed to being overly bullish or overly bearish like I am on Activision or Netflix. So that's just a quick example of the different ways that you can utilize OptionsPlay to analyze an underlying stock, and then make sure that you are utilizing the different strategies to set up a strategy that makes sense for the outlook that you have on an underlying stock. And remember, you want to ask yourself, do I have a strong magnitude outlook on the underlying stock in addition to my directional view to help you decide whether you're deploying your capital as efficiently as possible using options. So with that, I want to thank everyone for taking the time out here this afternoon. I know I covered a lot of things, so I don't expect everyone to remember everything, which is why we always record our webinars and we make it available to everyone for free afterwards. So as long as you're registered for this webinar, you'll be able to receive the recording along with the slides. And for those of you that don't already have access to OptionsPlay, you can sign up for your membership using this link that I just posted into the chat window. It is just $75 a month or $500 a year. And that gives you daily options trading ideas like the ones that we sent out with Activision earlier this week, weekly options education webinars like the one that you're on here right now, weekly cover call and short put reports for those of you like to sell cover calls and cash secured puts, and a free 12-step options trading course to help you jumpstart your options trading journey if you're brand new to options trading. So with that, what I want to do is I want to open this up for Q&A. I want to answer as many questions as I have time for here today. I know we have a lot of attendees here today. Thank you so much for taking the time out here every single week to attend these. I hope that you guys find this useful. So let's take a look at the questions that we have. So if you have any questions, type them into the chat window and I'll answer as many questions as I have time for here. So Kay Kevy says, my broker only let me perform cover calls. I'm not allowed short calls and short puts. What would be the best action to perform? So if your broker won't allow you to trade cover calls and short, other strategies, number one, you can request to see if you can get a higher level clearance. You can try opening your account at another brokerage firm that is maybe more favorable for these types of trades. If you have a question on brokerage firms, you can send us an email at info@optionsplay.com. I can provide some suggestions for you that may be able to allow you to trade those strategies. Patrick is asking, yes, can you give an example of a credit spread on that chart, previous slide? So I think the SPY is probably a good example of a credit spread where, I clearly defined a support level around 295. This is a pretty important support level for quite some time. It's defended that level for quite a few days, so it leads me to believe that that level may hold. But at the same time, I'm not overly bullish. I don't think the market is going to hit 310, 315 anytime soon, but I do think 295 is going to hold. So this is an example of when I would sell a credit spread. Let's see. Joseph Lynch said, always reading the tape, level 2. So there's many different ways that people like to analyze the markets. If you like to read the tape and do level 2 trading, absolutely. I don't know how important that is for swing trading or technical analysis, but that may be more useful for day trading. Let's see. My options play shows no optimal call verticals for Activision. So yeah, at the moment, I see that as well. And my guess is that it's because of the closing bid ask right now is probably not very favorable. So you can always construct your own and see what's available, but I'm guessing it's because the strikes that are currently available are not particularly favorable. But as you can see, if you really fiddle around with it a little bit, you are able to find some strikes that make sense. Dennis is asking, can we draw support and resistance lines when using options play? So we automatically draw support and resistance lines on the charts for you. We actually calculate support and resistance lines and actually draw them on the charts directly for you. Eric is saying, is the tech score the same as relative strength per your narrative? Yes. So what the technical score is trying to measure is relative strength. So Activision has very strong relative strength because, as you can see over the last couple of months, as the market has been relatively flat, Activision has been just moving higher and higher by a large percentage. It's moved from 45 to 55, which is almost a 15% move while the markets were basically flat. And that's really why you see a very strong technical score on a stock like Activision. And same thing for Netflix. That's why you see such a poor relative strength, because as the markets are flat, this stock is down 15, 20% over the last couple of months. Let's see. Am I hearing this right? The OP technical score is relative strength. Yes, the options play technical score is a measure of relative strength. Francois is asking, if you want to buy shares, what would be a good indicator? Support levels, momentum, and SMA? Yeah, so all of these, like I said, I think the most important indicator to use first is price, because price gives you, is the only true leading indicator. Everything else is technically a lagging indicator. So I always use price first, and then I look at support or resistance lines, and then I maybe use momentum to help me with my timing. Jason is asking, it would be helpful to show how to overlay some technical studies on the charts and options play. Great question, Jason. You can click on the expand button for any stock. You can click on studies, and you can add any of the popular studies or any of the 30 or 40 odd so different technical indicators that you can add. You can click on moving averages. You can type in the moving average that you want. So if you want a long-term moving average, you can click on that and instantly add that to your chart. So you can add that directly onto your chart. So great question, Jason. Thank you for asking that. Eric is saying, so please give an example of sell that level with the credit spread. So I think the SPY example, again, is an example of that. So again, 295 is that level that I think I want to defend on SPY. So I would sell a credit spread to defend that 295 level. So I'd sell a put credit spread to basically defend SPY to the downside at 295. Now, if you want to learn more about selling credit spreads, I highly recommend you to take a look at our webinars on credit spreads. So we have a full playlist of every single webinar that we do, and we keep it up to date so you always have the latest one. But I have one specifically on maximizing income with credit vertical spread. So I highly recommend you to take a look at that. And I just posted that into the chat window for those of you that want to take a look at our recordings. Jay is saying, how do you find and scan for stocks? Great question. So that's also something that we covered during our webinar on, let me find it here, gaining a directional edge in trading. So I use a lot of our watch lists. So I always start off with more of a top-down approach. I always look at the overall market. I get a sense for whether I'm bullish or bearish on the overall market. Then I look at individual sectors. I look at what sectors are strong, which sectors are weak. So given the fact that I'm still cautiously bullish on the markets, I'm going to focus my attention more so on the stronger sectors like utilities, technology, financials, real estate, consumer staples. These are the types of sectors that I would pay attention to, and then I would drill down into individual sectors. So if I'm looking at real estate or utilities, I would drill down into there, and then I would find the stronger stocks within those. And that's really how I found Southern Co., which was one of our bullish trading ideas a few days ago, was looking at strong stocks and strong sectors when the markets are bullish, and that's how we typically scan for ideas. John is saying, I signed up for a free trial but can't find the 12-step course. Can you send a link? Sure. John, if you could just send me an email at info@optionsplay.com, I'm happy to send you a link. Jesus is saying, why it takes a lot more time to close a debit spread. So I'm not sure what you mean by why it takes more time to close a debit spread. It should not take any longer to open or close a debit spread. So if you are having some trouble, I recommend that you call your broker and make sure that you're entering the orders correctly, and make sure, because it should not take any longer, whether it's an open or to close order. Alon is saying, slippage is a heavy cost for small traders. Can you comment? So I would argue that slippage is a cost for all traders, regardless of whether you're trading small or large. I think if you mean commissions, that might make more sense, but slippage is the same, regardless of whether you're trading 1 contract or 10 contracts. If anything, you might have more slippage with a larger number of contracts, because if you're trading just a few contracts at a time, usually you can get filled pretty close to the midpoint. So slippage is usually a smaller concern for small traders than large traders. When you buy David is asking, when you buy a spread and the expiration is approaching, when is the best time to close? And also, do you have to close each one at a time? So David, generally speaking, when you buy a spread, you generally want to close it out about no more than a week before expiration. You usually don't want to hold the spread into expiration. So a week out is usually a good time to consider closing out a spread, either at a profit or a loss. As far as closing each one at a time, you generally should not close out a spread one leg at a time. You should close out a spread both legs at the same time. So you want to enter one order that closes out both legs at the same time. Chris is asking an interesting question. He's asking, what minimum probability of profit do you recommend? Great question, Chris. I don't have a minimum. I generally will say that most of these debit spreads will, the lower end is about 30%. I generally don't go any lower than 30%. But 35 to 40 is usually the common probability of profit for a debit spread, is what is typical. Donald is asking, what are your favorite chart sites like stockcharts.com? So I'm partial to tradingview.com. I use TradingView a lot for my technical analysis, especially if you want to analyze lots of other asset classes like futures, currencies, commodities. I use tradingview.com myself. Wayne is asking, on the OptionsPlay daily today, a CenturyLink debit spread was offered. Would a credit spread also be an option? So you can use a credit spread, but a credit spread, again, is used to defend a level. It's not very good at taking advantage of a bullish view. So this CenturyLink trade was very similar to the Activision trade, because this is a stock that traded in a tight range for a long period of time, finally broke out above that range while the markets were trading sideways, showing me relative strength. And it pulled back from that breakout right back to that support level around $12.50. And what we were looking for is basically a breakout to the upside. So the stock, let me just draw this here for you. So 12.5 was a support level that held for quite some time. It broke out above that support resistance level, came back down to test that support. So what we're basically shooting for is a move to the upside, closer to that 15 level. So you can sell a credit spread, but if you sell a credit spread and the stock moves all the way up to 15, you're not going to have much to show for it, because you're just receiving maybe a 30-40 cent credit versus I'm trying to make $2-3 to the upside. So that's why, in my opinion, because I have a defined move to the upside, I have a clear sense for magnitude, a debit spread is far better, and I'm risking less money on that debit spread than I would if I sold the credit spread. But if you're not overly bullish on CenturyLink and you simply agree with me that 12.5 is a support level, then yes, sell that credit spread, because as long as the stock stays above 12.5, you're going to make money. But if the stock rockets higher, you're not going to make any more money than the 30-40 cents that you might collect on selling a CenturyLink credit spread. John is saying the daily play tracker is not updated and the link does not always work from the emails we receive. Is it updated every day or only weekly? So the portfolio is updated every single day. As you can see, the CenturyLink trade is in there from yesterday, so it is updated every single day. K. Kevy is saying, I tried to use 1 month free trial of OptionsPlay tool, but message said it expired. So K. Kevy, please send me an email at info@optionsplay.com. It means that you signed up more than 30 days ago and your trial has expired. For SPX day trade, what is the best setting for MACD? So MACD, whenever I'm using any technical indicators, I prefer to use the standard settings. So I prefer to use whatever the standard settings are. I actually, off the top of my head, MACD is 12.26.9. So exactly like what you said. That would be what I would prefer to use on MACD. Patrick is saying, in the SPY example, you said to sell a put credit spread. When I go into OptionsPlay and click on bearish, it proposes to buy a put vertical. Is it the same thing? No, those are two completely different things, because selling a put credit spread is bullish. Buying a put credit spread is bearish. So be very careful. If you are not familiar with credit versus debit spreads, I highly recommend you to take a look at my webinar on comparing maximizing profits with debit and credit spreads. In that webinar, I actually talk about the direct comparison between debit versus credit. It's really important to understand the difference, because you can easily flip a bullish trade to a bearish trade, and you don't want to do that. So Patrick, if you're new to this, please watch that video on debit and credit spreads. Gary is saying, did you say a copy of the slide deck will be available? Yes, every single Thursday when we do a webinar, afterwards we send you the recording, both the recording and the slides, so both will be made available to you. Donald is asking, how do you set up stop losses on spreads? So Donald, that depends on your broker. Some brokers make it easy, others don't. It's hard for me to comment on that. So I do recommend that you call your broker and ask them for helping you put up a stop loss order on a spread. VJ is asking, I have a question. I'm allowed to do transactions to buy, example, buying a call CCL 2019 October 4th, $49 call, but I cannot buy spreads like the CenturyLink trade. Do I need to get special permission from stockbroker? Please explain. So VJ, it depends on your broker. So as a broker like BMO in Canada, I don't believe supports multi-leg trading. So it's not that they don't allow you to do it, it's that they don't support those orders. So my understanding is that you can call your broker to have them submit that trade over the phone. So it really depends on your broker, but I believe BMO in Canada does not support complex trades. So you have to call those trades in. You simply can't enter those on your platform. David is asking, Francois is asking, when you buy a call with 60 days expiration, what would be the latest to close the trade? I usually think 1 to 2 weeks out is the latest that I would close out a long call like that. Chris is saying, how does POP relate to Delta, if it does? So POP relates to Delta on a single, POP and Delta are different. Delta tells you whether, they're both probability-based indicators, but Delta tells you the probability of the call or put being in the money versus POP tells you the probability of the strategy being profitable. So they're both probability indicators, but one is for whether it's going to be in the money, so 1 penny above or below the strike price, and the POP is based on the break even of your strategy. So it depends on the price that you purchase that call or put at. David is asking, if your call or put is not doing well, at what amount would you consider closing the trade? If you just buy a call or a put, I always cut losses at about 50% loss. If a call or a put has lost 50%, that means the trade is not going in your favor, and it's time to cut your losses and move on. What OptionsPlay score is the safest? What are the ranges that you recommend? So there's no such thing as a safe OptionsPlay score. An OptionsPlay score is only telling you the risk to reward of a strategy. So you could have the best risk to reward ratio, but if the trade goes against you, no matter how good the risk reward ratio, it's not going to be a good trade for you. So that's the thing to remember, is that the OptionsPlay score is not telling you whether it's going to perform or not. It's just telling you what the risk reward ratio is going to be. Let's see. John is mean. I meant the P&L tracker. Okay, John, I'll take a look at that. That's meant to be updated every single day. Chris is asking, what again is the service cost? The service cost is $75 a month or $500 a year. So you can choose from either monthly subscriptions if you're not comfortable with the annual subscription, but you do get a fairly heavy discount if you do choose to subscribe. So you can start off with the monthly and then upgrade to an annual at any time. And again, if you want to sign up for a subscription, you can sign up using the link I just posted into the chat window. Jesus says, why use a 3 to 4 week to enter a trade and not a 1 to 2 week? Great question, Jesus. Usually 1 to 2 weeks, the premiums are so low, you might not even overcome your commissions. So it depends on your broker and whether you pay commissions or not. If you have a broker that's 0 commissions, you might be able to trade a shorter dated option, but many times there's diminishing returns the lower you go because you end up paying you end up giving most of it back in commissions. So KG is asking MACD. So about long-term versus 2-minute charts. So the thing about MACD is that when you say 12.26.9, that's 12.26.9 of the chart that you're looking at. So a 12.26.9 on a 2-minute chart is a 24-minute, 52-minute, and 9-period exponential average of that. So it automatically adjusts for it. It's not a 12-day, it's a 12-period. So if you're looking at a 2-minute chart, it automatically adjusts for that. How do you decide on a stop loss? If you have a $12.50 stop loss on the CenturyLink spread, I only do mental stop losses. I'm not sure what you mean by a mental stop loss. The stop loss is based on what you paid for that option. So if you paid, in this particular case on the CenturyLink trade, we paid $1.25. I want to cut my losses at about 50% of the $1.25 that I paid. That's how you want to determine your stop losses. So the stop loss is not based on the underlying price, it's based on what I paid for that CenturyLink spread. John, you're very welcome. Eric, where do I see the P&L track record? So we publish it every single day with your daily play at the very bottom. You can click on daily play trades and performance. You can click on the link to see our daily play history. Patrick, thank you so much. Wayne asking about the credit spread service. Same thing. You get the link to the credit spread results in the email that we send out. We publish that in the same Google Sheets. Thank you, Tony, for another excellent webinar. Can you show support resistance level on Amazon? Sure. Let's take a look at Amazon. Amazon's got this major support level here around 1700 or so. Resistance around 1879, 1880 to the upside. If you want to be a little tighter, you can probably find some support around 1750 or so. Let's zoom in a little. So it looks like 1750 is an interesting support level, but I think the major support level here is closer to that 1715 level. And it did cross below that 200-day moving average yesterday. So that is a fairly bearish thing. But keep in mind, look, the last time it broke below that 200-day moving average, just spent a couple of days below it before it rallied back higher. So hard to say, but these tech names are becoming more and more under pressure from more political reasons. Hard to say as to what's going to happen, but the trend is certainly bearish. Relative strength is relatively weak. So I'm looking for perhaps a move to the downside, at least down to the $1,700 level. I think more likely you're going to get a retest of this previous low to the downside. I think it's probably likely going to happen on something like Amazon. Donald saying, you publish a weekly list of possible covered calls. Yes, we do. Naked put sales. How do you compile this list? So it's the same way that we show you. It's no different than how we look at the income tab here. We're basically taking the data that we have here and we're publishing it to you for you in a list. There's no different than what we're explaining to you during our webinars. So if you've ever watched our webinars on generating income from covered calls or generating income from cash secured puts, we're taking that methodology and we're applying it for you on that spreadsheet. So with that, I've taken up enough of your time. I hope that everyone has found this this webinar useful. Like I said, this is one of my favorite topics to talk about because it is near and dear to my heart, and I spend a lot of time on technical analysis. We talk about it in all of our daily plays. So I hope that you guys find this useful, and I hope that you guys are able to apply this in your own trading. So thank you so much for taking the time out here this afternoon and participating and answering and asking all your questions. So I appreciate you guys taking the time out, and I will see you guys next week. Have a good evening.